Hi, welcome to the Market Alert for Friday the 13th of October 2017. So yesterday the pound moving sharply lower on news that the Brexit deal was no deal, and then for whatever reason, whether there was a deal or not, the pound put in a reversal and moved back to the upside there. A very strange day, but then again we're living in strange times, as we've seen during the last week. And in the daily chart of the pound, heading back to the 132.87 level, there you can see the market pushing on this on the overnight market there. It needs to take this out. You can see yesterday the market traded up to this level after recovering. I'll move that one, and we'll save that. In the news for today, what have we got? There's a bit red here. Let's have a look. See if there's anything major that jumps out there. Is it just usual stuff? CPI for the US. Again, we talked about this yesterday in Yellen and inflation. I mean, just look at this. 0.2. It's just absolute, complete manipulation. It's been 0.1 for goodness knows how many years. It's absolute nonsense. Inflation is probably one of the most manipulated figures on the planet. We all know, as I keep going on about when you go to the supermarket and the price of goods going up and so on, but it never seems to reflect in the CPI or the RPI, particularly in America, where it has been 0.1 for years. Again, you'd have to be a complete nutter moron not to see that that wasn't being rigged. Also got the retail sales. Now this is good news. This is what I mean about all forecast up 1.7. This is not coming out at 1.7 if the unemployment figures come out at minus 33,000 in reality, because they'll it'll come out negative and then they'll blame the hurricanes again, stop people from shopping, which obviously would be a factor. But it's interesting that they're predicting 1.7 on this, and then CPI there. And we've got Evans out. We've got the prelim UOM consumer sentiment, and then Evans and Kaplan are speaking at 3:25 and 4:30. Get the market up. They want the market up. That's the motto and the mantra they've had for the last 10 years. And speaking of which, the Dow didn't trade yesterday. Took my own advice. You can see it's just so narrow on the open. You're not even getting the signals filled until this bar here. It just shows you how quiet the beginning of the session was. And then we managed to just crawl all the way up, make a new all-time high, or back up to the highs. I think that's a new all-time high. And then the market just fizzling out there before the end of the session. Yes, it was a new all-time high, and I'm just going to mark that up for you and remove the other one. There we go. We're getting closer to that 23,000. You can see there that we're at 22,886. So not too far off there at all. 114 points, I think that is. And market moving higher on the overnight. So there's no doubts about it. We're going to 23,000. That's 1,000 points on in no time at all. And it's not sustainable. And indeed, an article in the Financial Times. This was out, but didn't make too much on the mainstream. The IMF warns of vulnerabilities that could derail the global recovery. Well, one, there hasn't been a global recovery. There's just been the printing of debt. And as the report highlights here, the G20 countries have a total debt pile of a staggering 135 trillion, and it's fueling risks. Well, there's a surprise. This stuff it really is elementary, and you've got a situation again where we've got this complacency that we had in 2008 before the whole lot went pear-shaped. The International Monetary Fund has warned that good times in the global economy mask longer-term risks, including 135 trillion debt pile in G20 nations that companies and consumers are already finding more difficult to service. What did I say yesterday? People, all-time highs in credit card debt globally, within the G20 countries, and difficult to actually service it. So, again, it's I like the parting shot here. It says, while the waters seem calm, vulnerabilities are building under the surface. Too right they are. And if left unattended, they will be left unattended, because there's nothing they can do about trying to clear $4 trillion off the balance sheet. These could derail the global recovery. No recovery. There is no recovery. We'll cross that out, said Tobias Adrian of the IMF's financial stability watchdog. The only thing that's been created are asset bubbles, which we have seen all over the place. Right, let's have a quick look at the implied volatility before concluding. And here's the proof that it's incredibly quiet. We've got 750 down from 751. That's how quiet it was yesterday. Just 0.01 drop there in the implied volatility, and the market continues to move higher. It's getting narrower in range now. You'll probably notice this as well. We've got no spikes this week at all. All we've got is just a sideways, sort of a coiling effect of the implied volatility. And when the markets do this, it will explode out of it. There's no doubts about that. It will not be sustainable. The longer this goes on, the more the coiling, the greater the energy that will be released when it does go. Can't tell you the date and time. Nobody can. But we know from all of the factors around and how it feels and what we're actually seeing that it can't be too far off, or even just for some sort of a scare. But again, we're going to have to sit it out and wait until that actually happens. Right, that'll do it for this one and for this week. Let's hope things improve a bit today and we start to see a bit of volatility come back into the markets. Painfully quiet week. But like I said before, it's out of our control. There's nothing we can actually do about it. Right, that'll do it for this one. As ever, thanks for watching. See you in the next one.